Good morning. Welcome. It is half an hour before the market is going to open on Thursday. Is it Thursday? I think it's Thursday, June 13th. Yesterday, we had the FOMC announcement. We had the CPI report. We gapped up on the CPI report, did nothing on the FOMC announcement. A couple of things that were very important that Powell said was basically that number one, their data, the CPI data, was not enough for him to consider cutting rates. And number two, they're really only still just anticipating one rate cut this year. So he basically said exactly what he has been saying, and there's no change. However, the CPI report did send the TLT up, and this morning we're still at elevated levels. We have the PPI report this morning, so we'll see how that came out. And it looks like it's probably confirming what the CPI report said. Then it's not going to have a huge impact, because if it's just confirming whatever the CPI report said, well, that information is already known and priced in to the market. So it'll just have a very minimal effect. Maybe it's slight, small blip upwards, sort of like what we're seeing in the TLT right here. So let's take a look at that. PPI. So year on year is what we really care about. We don't care too much about month on month. So 2.2, 2.2, no change on the headline PPI report year on year. And then the X food and energy year on year, that's the one that came down a little bit, 2.4, 2.3. So very mildly better. People might get excited about this month to month right here, -2. So actually came down instead of increasing. So everything else we're just saying for 2.4 to 2.3 is just, hey, it's going up a little bit more slowly. It's still going up. It's just going up more slowly. This one is, hey, it actually decreased a little bit. So people might get excited about that, but really the one that we care about is this, the year on year and this year on year. So it's not going to have a huge effect on the market. If we look at our S&P, we can see that it blipped up right there. That's 530, that green bar right there. And we basically undid everything, almost everything since then. So it looks like the S&P is up slightly. Let's take a look at those futures. S&P up quarter of a basis points, so random even after that PPI report. We got our NASDAQ up non-randomly at about 2/3 of a percentage point. And then we have the Dow down 15 basis points. So we're continuing to have this big divergence between the NASDAQ and the Dow, and that's not good news. It can't keep on going forever. Yesterday, we went and looked at a lot of momentum levels in the post-market. We saw that this market is still being propped up by just a few stocks, and mostly the tech sector, or specifically the chip sector. So if the wind comes out of the AI enthusiasm, then this whole market is collapsing. Right now, we're seeing that with Apple yesterday and the day before and yesterday, these huge movements upwards. All they did was they showcased their new iPhone and said, hey, we're connected to AI now. And you had this screaming, raging buying spree in Apple. So basically what's starting to happen is companies just say AI and their stock goes higher. We saw that last year too in the S&P or the QQQ. A lot of these companies say, hey, we're using AI. And then the stock market kept going higher. Those companies kept going higher on their AI announcements, which generally came during earnings announcements. So even if they had poor earnings and they mentioned AI, their stock still went up. So that starts to sound like a craze and a bubble, and it's increasing and continuing now with Apple announcing their integration of AI into their phone. Before they said, hey, we're taking our Apple Car team, we're scrapping that project, we're going into AI. And that sent their stock higher. And then they announced a couple of days ago that their new iPhone is going to integrate AI. and that sent their stock way, 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 way higher. So what we're seeing is that super craze era of a bubble. And what we need to anticipate is that at some point, not necessarily soon, it could be 1 or 2 years later, that bubble is going to burst, and then we would have a .com like event. So during the .com era, companies were just web. We have a website now. We're going on the web. And their stock would go crazy. And then the last phase of it was we started to have companies IPO, never have done any business, have zero revenue, never made a single sale, and they would be able to IPO and their company would be valued at hundreds of millions of dollars. That was the crazy, crazy, crazy phase of the .com. I don't know if we'll get that extreme with AI. Maybe the markets have learned their lessons, but that was over 20 years ago, more than 20 years ago. So maybe not. Maybe we've got new players and new kids in the market these days, and they don't remember that stuff. So we could get to the point where we do get that crazy. We're not there yet. But if we do get there, that's a clear sign that we're a lot closer to the bursting of the bubble. So this market right now is really just being held up by this AI craze, and it's got to be able to stand on its own at some point. Otherwise, this will revert and this will collapse. So if we look at, I already did a thorough job of looking at the momentum levels yesterday in the aftermarket. So if you want to review, just take a look at that. But I'll just make one more point that I didn't make yesterday. And that is, if I look at, let's see, where are we? We are on June 12th. Okay, today's the 13th. The last data point we have is the 12th. So if I go and I look at May 12th, May 13th, I guess. So we were at 521. And yesterday we were at 541.42. So 20 points, went up 20 points in this last month. Okay, let's look at the equal weighted. Monday the 13th, equal weighted, we're basically down. We were at 166 and now 165, flat, mostly flat, slightly down. But that is a very different story than what the S&P is showing. If I look at momentum levels over here and just look at the whole overall market, we had last month 58% of stocks above their 50-day moving average. And today, 46. So the S&P is not reflecting the actual conditions that it's in. We're still looking at that social media, everything is beautiful, look at my perfect life picture on the S&P. And then underneath, what we're saying is, oh man, I'm actually really depressed and I have a terrible life. I'm just trying to put my best foot forward on social media. Yeah. So this can't last. It can't keep on going. So for that reason, I'm not super enthusiastic about this all-time high. I'm not buying into it. We could go a little bit higher, but not for much longer. And we will need a correction, either a pullback or a correction. So we'll just wait. We're not going to front run it, but when we start to see the prices actually turn back down, then we'll know that we're getting that pullback, maybe even a correction. In terms of TLT, it looks like we're opening it slightly higher because of that PPI report, but this also cannot last. Powell very specifically said, the data is not enough for me to consider a rate cut, which means that it's not going to happen in July. It's not. I've said this too many times, but one data point doesn't make a trend. One data point doesn't tell you that you're making progress. And in fact, it's just that we're just slowing down inflation. We're not making progress towards decreasing inflation. So we need to get down to that too. We could do it by saying, oh, three on a year to year, it will look like it's 3.5, 3.2, 3, 2.5, 2. It will look like that. But on month, it's got to start looking negative in order for us to get down to that level on year. So we're not printing negative numbers. We're printing smaller positive numbers. So it's still increasing. It's still going up. It's not contracting down. So this is not realistic. This 10.3, it still does need to go down to 0. If we do get that rate cut, which he said 1, it's not going to happen in July and very unlikely to happen in September. It might happen in November or December. So this trade, we might see this irrationality last. It might actually bump up even higher, 12, 13, 14, 15%. If it does that, then for sure we're going to go in and short it again, because this is, I still have very high conviction, over 99% conviction that this is going to go down to 0. So yesterday, volume just barely came back. We had the 63 is the end number off of 58 or 59 million of the average. Number one, the average came way down because we had so many weeks of under average volume. And yesterday we had the volatility and the algos trading the FOMC announcement, which, by the way, was anemic. We haven't seen this flat and this uneventful of a price action after a FOMC announcement in the last, ever since Powell came. We've never seen it this flat before. So basically, there wasn't a lot of participation. The algos were still trading. The institutions didn't come back in. The only reason we managed to hit and cross barely the moving average right here is because there was that algorithmic trading. If we didn't have that algorithmic trading going on, then we'd still be back down below the moving average because the institutions didn't come in. So we need to see if institutions come in today. The PPI, all it did was reflect what the CPI did. So I'm not too hopeful that we'll get the volume today. We might get it tomorrow with consumer sentiment because that will reflect on GDP and even more fundamental and underlying clues of where the economy is going. The economy, remember, the stock market will front run the economy. It'll lead the economy. So they don't share the same cycles. They're actually off phase. So if we see signs that the GDP is weakening, the stock will drop. The stock market will drop and actually weaken before we see the economy actually weaken. So that sounds weird, or it sounds like I'm saying the same thing, but what I'm saying is, hey, it looks like we might be weakening and the stock market is already weak. That's the way it'll work. So if we say tomorrow with consumer sentiment, we say, hey, it looks like the economy might be weakening, then the stock market will go ahead and just start moving downwards. But in any case, we should at least get some indication of volume, and hopefully the institutions will come back in tomorrow or Monday after the weekend. So we're just still waiting for that volume to come back in this market, because we can't trade with, well, we can trade, but it's a lot easier to trade and it's a lot easier to find good trades when you have volume in the market, because the institutions are the ones that push and move things. I talked about this earlier this week. If I have $1 million or $5 million as an individual, and I go in, I want to buy stock like, not NVIDIA anymore, but just say Broadcom, okay, $1,500 a pop. If I have $1.5 million, I can only buy 1,000 shares. And this stock is trading 5 million shares a day, on average $2.5 million a day. My 1,000 shares isn't going to move Broadcom higher. It's not going to, and even if I could move it, a whole bunch of individuals with $1.5 million, yeah, maybe we will move it, but can we do it again tomorrow and tomorrow and tomorrow and tomorrow? Can we keep pushing this up? The answer is no. Our capital is too limited. But if I'm an institution and I have hundreds of millions of dollars or billions of dollars to put into the stock, well, I can't even finish my buying in one day. I'm trying to buy 50 million shares, and today, that's going to take me 20 days of average volume in order to get my order filled. And that's why the stock will trend, because I'm buying and then I'm buying and then I'm buying and then I'm buying and I'm buying. And that's why we see these trends upwards. So until institutions come in, the S&P is going to look like this. It's going to look like this box. It's just going to chop sideways inside this box. So that's why I consider this an anomaly. I'm not convinced yet that this is going to move upwards. However, if institutions come in today, tomorrow, Monday, Tuesday, and start pushing this up, then yeah, it can absolutely move upwards. But until we see volume come back convincingly, then this is just an anomaly. Okay. All right, so today I'm anticipating probably mostly a quiet day. We might get some spillover momentum from yesterday, but other than that, I won't really expect the S&P to traverse like huge amounts of territory. So we're probably talking about 540 to 546, or on the outside 538 to 548. That type of range, not a huge range. Just like yesterday, even with all of the announcements, the CPI report and the PPI report, we were stuck in this 540 to 544 range, just 4-point range. So I'd be surprised if we move beyond 4 points today, because the PPI is nothing compared to those two. And if we didn't move on those two, then we're really not going to move on these two unless the volume comes back. And again, I don't expect it to come back today. I could be wrong, but not expecting it. So probably a quiet and choppy market today, and then we'll see what happens tomorrow.